Good afternoon, everybody. Thursday, we're almost there, folks. We are almost there. Market is a little tired. It is. Um, we're not as down as much as we were about a half an hour ago, but S&P's down about 22 points right now. What is that? Pair we'll get to see what happens. A lot. Chair Powell's talk. When is he talking? Zora, I didn't know Powell was talking. Okay, we'll see if there's any market reaction to that. So S&P's down about 22, 23 points right now. Dow is down about 150, and the Nasdaq is down about 75 points. Volatility not really moving too much, but just over the last really 15, 20 minutes or so, there's been a couple very noteworthy pieces of info affecting the marketplace. The first one was about 20 minutes ago, and something to the effect that the government is going to stop giving credits for EVs. I will try and get the full headline on that. I think it was a $1,500 credit that the government is going to stop giving. So all of the electric vehicle makers are getting hit, including Tesla. Tesla is not down quite as much now as it was, but I know Rivian, some of the others are getting hit. And then just a couple minutes ago, there was a headline about Microsoft and that the government is targeting Microsoft again. Regulators planning to investigate Microsoft's cloud business. Kind of seems like rinse, wash, and repeat. Quite frankly, I know the stock dipped about $3-4 on that news. It's rallied back a little bit. We'll have to see, if that really takes hold. Usually, when news comes out like that, it's a really good opportunity to either buy the dip or sell the rip. So we'll see what happens there. But nonetheless. There's some good trade activity out there. One thing that many of you have on, if you're in my room, we have this Shopify position. And it's a good thing that we're talking about Straddles and Strangles today, which we'll get into shortly, because we actually had a double strangle or a double calendar, if you will, position on Shopify that so far has paid out about 50% on 3/4 of our position. So we'll get into that real soon. And then you guys will have the opportunity, hopefully we'll have some time here, where you guys can give me some stocks you want to take a look at, and we can look at Straddles and Strangles. All right, everybody. This is a topic that came up because one of our listeners asked, can we talk about Straddles and Strangles? Okay. And as many of you know, option strategies can have some funky names to them. Butterflies, condors, straddles, strangles, who knows? But when you really break it down and you look at what these strategies are, okay, they're really just combinations of types of positions that we know about, that we put on often. Okay, so don't ever be swayed away, intimidated, whatever word you want to use, on what the name of a position is, the name of a strategy is, and just say, oh man, I can't understand that. I'm not going to trade that. I'm going to pass on that. Because actually, when you take a deeper dive into it, again, usually just a combination of things that we're already talking about. The aluminum buzzard, Robert. I'm going to let you come on and explain the aluminum buzzard. I love that. All right, guys. So Straddles and Strangles. Okay, we're going to talk about at first what they are from the long side or the buy side. Okay, remember, if we talk about something long, that means you bought it. If we talk about something short, it means we've sold it. Okay, so a long straddle is buying an at-the-money call and put. And you can think of it this way. Okay, if you have a straddle, you're straddling a stock price. Okay, so Microsoft right now or Apple, Apple's trading $227. If you straddle that stock price, you're looking at the strikes closest to at the money. Strangle, okay, a strangle, same concept, okay, but the way that I like to think of a strangle is you're coming at the stock, you're attacking the stock from both sides, like this. So it's not straddling right where the stock is, but you're coming at it from lower and from higher. So you're using an out of the money call, out of the money put. Okay? In both of these scenarios, if you put that position on, okay, in both of these scenarios, you're looking for the stock to make a big move. Okay? Think about it. If you own a call and you own a put, okay, not a spread, a call spread or a put spread, but if you own a call and own a put, you don't care what direction the stock moves. You just need one of those to increase in value, big time. Same on a strangle, okay? A strangle, same concept, but you have to get a bigger move to make money on that position. Okay, now you might say to yourself, well, if I got to get a bigger move, but why don't I just do the straddle, right? If I don't need as big a move. Well, what is the difference? What's the risk between a straddle and a strangle? Okay, and we'll look at some examples, but let me ask you guys, what's the big difference of a straddle and a strangle? Yeah, Derek, nicely done. A straddle's more expensive. Okay, why is it more expensive? Well, if you're comparing a 50 delta option, which is at the money, versus an option with a lower delta, whether it's 20, okay, to the downside, 20 to the upside, whatever it might be, that at the money option's always going to be more expensive. So even though in a straddle, you don't need as big of a move to start getting some profits back, it costs you a lot more typically to get in. Okay? And then obviously we're going to talk about when is the right time to get in and implied volatility. Okay? So this is a very basic look at what P&L graphs would look like for both a straddle and a strangle. And you can see the straddle graph has a deeper V to it, a deeper move, and starts making money, okay, quicker. Okay? But the loss is potentially deeper because you're paying more for it. Okay? And when we go through shortly here some live P&L examples here, I'll put up a live P&L chart and you'll be able to see the difference. Okay? So I wish my drawing tool was working. I don't know why it is not right now. Maybe I can't draw on this PDF. That is possible. Okay? But long straddle, long strangle. Now, what is the difference between the blue curve that you see and the black curve that you see, both on the straddle and on the strangle? Okay, the difference is time. The difference is time to expiration. Okay, so the blue is always going to be flatter, more moderate, because you're looking at something in real time. But because we know that time costs money, okay, that theta decay, that factors in. So the longer you hold a position, or if we go out to expiration, that is why not only that loss deepens if the stock doesn't move, but it also, the gains are much, much greater if you do get that move in either direction. Okay? Now, big thing that we really need to discuss, because it's something that we trade here a lot. In fact, that was the Shopify position. We have the exact same type of position on in Palo Alto right now. We need to understand implied volatility, and if and when there is going to be an implied volatility crush. Does everybody know what I mean when I say crush? Okay, and this kind of feeds back to also, when do we want to trade something like this? Okay, when do we want to trade something like this? Okay, if we're buying time, whether it's a day, a week, 6 weeks, 3 months, okay, and you're looking for a move in either direction, okay, when do you want to buy that time? Okay, good job, everybody there, answering the question about the IV crush, and we're going to go through that. But when do you want to buy that time? Yeah, you want to buy it when it's cheap. You want to buy it when implied volatility is really inexpensive. Okay? Because you're buying time cheaper. So if we look at what happens at earnings, okay, which you can see right here, what happens at earnings? Well, we know here that at earnings, the uncertainty of the event makes volatility move higher. Okay, we know that for a fact. And then once the event is over, in this case, the earnings announcement, regardless of how the stock reacts, higher, lower, unchanged, whatever it is, that uncertainty is gone. That's where we see that big implied volatility crush. We have to understand that that is a nuance that happens. We have to understand how to trade that. Again, that is exactly what we look at when we're trading our strangle positions, our strangle swaps. We rarely trade straddles or straddle swaps in here just because typically they're too expensive. We can get typically equivalent or even better bang for our buck by trading strangles and strangle swaps. Okay? Does that make sense to everybody? All right, guys, before we go any further, what have we got today? Groucho says straddle. Word of the day, straddle. Get your entries in, get it in the chat here. All right, for our wheel spin in about 15 minutes. All right, we'll leave this up here for another 10, 20 seconds or so. Let's get straddle up there, and then I am going to go into a real live, while the market is moving now, position, taking a look at a straddle and a strangle. And I'll break down the implied volatility part of it, especially when we're looking at that going into earnings. All right. Keep that straddle word coming at us, guys. Okay. Somebody I know wanted to take a look at Qualcomm. Okay, Qualcomm just recently had earnings. Okay, it was about a week and a half ago. So we would expect, and we'll look at it here in a second, we would expect that volatility would be down quite a bit from earnings. And we can certainly see that. That is reflected here. Okay, this big dip right here. Now, if we look at an implied volatility chart here, and this is a 1-year chart, we can see after this big dip here, vol, is getting lower. Now, I wouldn't say that it's really near the bare bones bottom or anywhere close to the bare bones bottom. It has gotten a lot cheaper. So if I were to look at this chart here, and if I were to look at a position, okay, that I would want to put on, okay, I would say maybe I'd want to be long a little volatility, but not entirely indicative that vol is not going to go lower from here. Okay, now, if we look at the stock chart, we can see after the dip here from earnings kind of leveled off. Okay, like I'm part of the company. Okay, if you look at a Qualcomm chart here, boy, this thing has really traded in a pretty moderate range, okay, for a very long time. Even if we go back to here, this thing has traded in a range since, when is this? Basically 3 months. Okay, basically 3 months. Okay, Qualcomm doesn't typically stay in a tight range. So I do think that the suggestion of buying a move in either direction here makes sense. Okay, it makes sense. Now, let's just look at something here. Today is what, November 14th? Let's look at putting on a strangle and a straddle position going out a month from now. Okay, so we'll look at December expiration. So if we were looking at a straddle where we're really looking for a big, powerful move in Qualcomm, we'd be looking at the money. So we'd be looking at this 165 strike expiring in December. And that's going to cost us about $14. Okay? That's going to cost us about $14. Now, you don't ever have to hold a strangle or a straddle position until expiration to do something with it, to make money, to lose money. Okay? In fact, I would say most traders don't hold it till expiration because you will see fluctuations in your P&L depending on if the stock is moving and if volatility is moving. Let's see what this chart is going to look like here. Okay? Now remember, I think we talked about this maybe last week, maybe a couple weeks ago. We talked about back spreads. And we talked about a smile. Okay? When you own options, when you own gamma, especially closer dated options, you get what is called a back spread position. This is exactly that position here. You make money to the upside, you make money to the downside if the stock moves. If the stock moves. If it doesn't move, there's your risk. Your risk is that theta decay. Okay, so let's now isolate this. Okay, here's what it looks like today. You want that stock to move to make money. You don't care which direction. You don't care which direction. Now, let's take a look at this a month from now as we get closer to expiration. You've got the same shape. You've got the exact same shape. But look what has happened now to your P&L. If we're sitting here at the same place, here's your break even. Now all of a sudden, all of this is a loss because that is what? That is your theta. That is your premium. Okay? Compare that to, can't really overlap it, but compare it to this chart that I showed you earlier. Here we are today on the blue, right? Moderate curve. But as we get closer and closer to expiration, if that stock doesn't move, there is that V, and this is a loss. Does that make sense to everybody? So when you're looking at a straddle, actually when you're looking at buying any option premium, buying time, you want to minimize the amount of that loss, the amount of that premium. How do you do that? You do that by buying options like that when volatility is cheap. Okay? That's why in every position we put on, everybody, not only are we looking at direction, we are looking at premium or volatility. Okay? Now, let's compare that to putting on a strangle position in QCOM. We're going to use the exact same expiration. Okay, we're going to use the exact same expiration, but we're going to use options that are away from being at the money. Okay, now, the closer you are to being at the money, the more expensive it's going to be, and the deeper that move is going to be. The further you go away, the less expensive, and the more moderate that move is going to be. So let's look at 10% move away. Okay, 10% move away is pretty close to what the expected move is. So we can look at the 150 put and the 180 call. Now the straddle costs us about $14. Okay, this strangle here would only cost us about, $3.50, $3.70, somewhere in that range. Okay, so if you were going to allocate the exact same dollar amount, okay, one straddle would cost you $1,400. One strangle cost you, let's say, $375. You could do basically 4 strangles, okay, for the same price as one straddle. Does that make sense to everybody? Now, let's look at that curve. Let's look at what the P&L would look like on a strangle as opposed to a straddle. Okay, this is what it looks like today. And you can see, even though it's still a smile, right? We still want the stock to move. It is not as deep as a straddle is. We need a much bigger move. Okay, and then if we project this ahead to expiration date, okay, now you can really see how much of a move you need, but your loss is also quite less than it was in a straddle position. Okay, let me bring this back in here. Okay, and here is the look at what I had put up before. For the strangle, you can see wider curve to begin with and flatter at expiration, not as steep of a loss. Okay, everybody understand that? Everybody understand that? And I know we have a limited time, which is why we're going to talk about this part of it tomorrow, because this is critical, and I don't want to shortchange anybody. I don't want to cut this part off because we use this in our trading so often. It is so important. I want to dedicate an entire Market Mind live stream to the IV crush. I want to dedicate an entire live stream to our position that we just have in Shopify or in Palo Alto. Okay, this is our Palo Alto position that we currently have, guys, and look what we have. Okay, the stock is trading basically 400. I know, 395, but it's basically 400. We've got positions $50 out of the money to the downside, $75 out of the money to the upside, as opposed to a straddle swap using at the money the 400 or the 405. Okay, so what we need here, what you will see, is as we get close to expiration. Okay, and what we have here is a short strangle that expires next week and a long strangle that expires the following week. Okay, where do we need the stock to go? We don't want it sitting still. Where do we want it to go, guys? What is the magic answer? No matter what position we have on, what is the magic answer of where we want a stock to go? Yes, there we go. Boom, the short strikes. That's why you're all part of the short strike club. So look on this graph here, guys. Where is the high point of the P&L on the upside and the downside? Right here. That's at 349.77 on this graph. We have the 350 put. Okay? On the upside, 476 and change here. We have the 475 call. You need that movement. You need that movement. Okay. So, yes, tomorrow, you already know ahead of time here. Tomorrow will be, and let me write this down right now. Tomorrow will all be about IV, implied volatility crush. Okay? I know someone I saw in the chat here put in, oh, I know the word of the day today is going to be crush. Well, now you know what it might be tomorrow. That would be really apropos for tomorrow. Today, Groucho said straddle. Today, Groucho said straddle for that final spin at the wheel here today, guys. Okay? Help us out. Help us out. I don't ask for help often. Help us out and smash that like, share Market Minds with people. Let people know we're out here doing this live every single day. Because I guarantee you, just like I saw Jay mention in the chat here a minute or so ago, I'm not able to be in class in the morning, so this really helps, okay? Thank you, Jay. Thank you, thank you, thank you. Really appreciate it. Share the love. Spread the love, everybody. Okay. Do we have, Michael Clark, do we have the wheel ready for today? And remember, you gotta be here. You gotta be in it to win it. All right, I am just waiting for the wheel here. And again, as always, guys, if anybody ever wants a copy of the presentation, the PDF that I put up there, just let us know. Okay? We've got our wheel for the day here. Ooh. Don't know if it's a record, but I know I need new contact lenses, but It's looking pretty good here. It's looking pretty good. Thank you, Jay. For sure, it's a like smash. I love it. All right, guys. Here we go. No drum roll. I'll give it a little drum roll. That's a bad drum roll today, but here we go. The wheel today says William C. or Howard Simmons. It is close. Howard Simmons, I think we've got a newbie. I think we got a new winner today. Howard Simmons, are you around? Are you in the house? Howard Simmons, are you in the house? Let us know. You got, give you 8 seconds to respond that you are here. Yes, Howard, nicely done. Shoot me an email. prosperswag@prospertrading.com. Shoot me an email with your mailing address and your size swag. Oh no, I misspelled that in my haste to type here. Hang on. prosperswag@prospertrading.com. There we go, not prospertrading.com. We get enough impersonators out on the web as it is. Don't need any more. Okay, one thing I want to just kind of let everybody know about also. Every quarter or so, we do in-person education where our students come into Chicago. It is a first-class VIP experience. And you literally work for 3 days with myself and Mike Shore and Charlie Moon and Michael Patton and Drew on the gold side. You literally work with us all day long and trade with us all day long. Okay? And we take you down to the trading floor. And we do all sorts of fun stuff with you. We put you up at a great hotel. If anybody is interested in our next in-person fly-in event, it is December 3rd, 4th, and 5th in Chicago. And what I am so excited about, and I was just there yesterday checking out the space, the CBOE is actually allowing us to come into their corporate offices and use some of their big space. So we will be at the CBOE building. We will be going down to the trading floor. We will actually have people from the CBOE coming in, talking to us about zero DTEs and the VIX and all sorts of great stuff. If you are interested in something like that, okay, oh, there we go. Vangal, who is Zora, has done it. She has done it. She has been there firsthand. Okay, just do me a favor. In that same email that I put up here, prosperswag@prospertrading.com, if you're interested, just shoot me a quick email and I'll send you all the details on it. All right? It is a great experience. All right, everybody. I really appreciate everybody being here today again. Tomorrow we will continue this. We will talk about IV Crush. All right? Thank you, everybody. Have an amazing, amazing Thursday. Got Thursday night football tonight, guys. See you later, everybody.